it's really been quite a time, right, in the news flow. I mean...
It has. I mean, we couldn't ignore the events of yesterday, I think.
No, I know. Trade war extremes, maybe a little bit of trade war moderation now, but how are you thinking about the gyrations, and also how do you factor them into your daily work life?
Well, first of all, thank you so much, Annabelle and Bloomberg, for having me and Morgan Stanley at this really important launch event. I think it's critical for Bloomberg to be doing this for new and diverse voices, and I'm so proud to be involved and certainly hope to do it justice. Now, clearly we can't ignore the events of yesterday and all of the recent volatility that we've seen in markets, but if I may just take a little bit of a step back and set the scene. At Morgan Stanley Private Wealth Management Asia, we service the ultra-high net worth asset owners and entrepreneurs with traditional but also institutional wealth solutions. I look after the investment management services business, which is also known as the funds business. And it is our job to help our clients to navigate through this volatility and, if anything, stay the course with long-term structural trends. Now, to the point of recent volatility and the tariff de-escalation, as dramatic as that was, if anything, Trump set the tariffs so high that he only really increased the probabilities that there was only one direction, and that was down. So we had expected a de-escalation in tariff tensions. That has come in thick and fast, but the reality is, it's, you know, for now it's for 90 days. 90 days isn't a long time to reach an agreement on tariffs, and there are many line items to get through before we are really of a level where there's a lot more certainty in the markets. So we are staying the course. Now, what this has thrown up?
Yes, go ahead. What's the course?
This has thrown up very interesting opportunities, what it means for US, what it means for China. In the US, of course, that sets the scene for a recovery in growth names again. We've seen that levels are not back to all-time highs, but they're back to pre-Liberation Day levels. And we're seeing that certainty really start to improve the outlook for growth names in the US.
That US exceptionalism story, though, there's been just so much debate around whether it's still intact. Do you see that being the case?
Well, I think it's interesting because the conversation about US exceptionalism and the challenge to US exceptionalism has very often been associated with the Magnificent Seven. And the Magnificent Seven, as much as that leadership in the US has been driven by the large cap or mega cap stocks, it's not synonymous with US exceptionalism. US is still the deepest and highest quality market. There are many areas within the US to traffic that are very interesting. There is still significant innovation coming out of the US. And if anything, yes, we had experienced higher levels of valuations that were necessarily comfortable for clients to be getting into with fresh money. Now we've seen that retrace a little bit and actually setting a healthy scene to get back into some of these interesting names.
As it retraces, though, and maybe some funds flow away from the US, where do they go into? What are you advising clients?
So on the other side of the US is actually what we've seen now in China. We're seeing an emergence of really interesting themes coming back out in China. We're seeing that China is emerging from being the world's factory, from making and manufacturing products for everybody else and servicing everybody else, to actually becoming a global leading innovator in its own right. And opening and paving the way for repositioning in China. Valuations are not demanding. We've seen significant investment in R&D, talent, capabilities, their own supply chain, and we're actually very interested in and excited about the opportunity set in China.
What's the right proportion, though, to allocate to that market?
So in terms of global asset allocation, our investment committee is recommending something like a 40-40-15 split between fixed income, equities, and alternatives, with the balance in cash and cash equivalents. Now, rather than allocating to specific markets, it has become increasingly important to have a globally diversified portfolio to navigate through that volatility. This is why we have seen alternatives take up an increasingly important role, a core function in client portfolios. Now, a 40-40-15 model is designed to help an ultra-high net worth client with a balanced growth objective achieve something like a 7 to 8% total return over a 7 to 10 year horizon, but with about the same degree of volatility. Now, if I set the scene in terms of what that means, achieving 7 to 8% returns per annum with about the same volatility in an environment where volatility is elevated is significantly harder work than, say, in post-GFC era where volatility was much lower.
So alternatives are sort of, we were talking about it earlier, taking on sort of a dual mandate now in someone's portfolio.
That's right. Alternatives has moved significantly from what used to be an area where there was very high beta, idiosyncratic, binary type returns, an area where clients might add into their portfolio to get a little bit of juice into their portfolios, but now actually has moved and developed significantly where they now play a risk mitigation function, a diversifying function, an area where you can get alternative streams of alpha. And this has become very important where volatility is high.
Against the backdrop, though, what are the kinds of returns that your clients are expecting today, and has that shifted at all?
And that's a very interesting question, because one of the biggest developments we've seen in client behavior, especially in this region, is a move from outright outperformance objectives to a much more conscious risk budgeting approach. We've seen our clients become much more conscientious about the risks and exposures that they're taking, much more judicious about volatility budgeting, and having a very clear and set idea for what each part of the portfolio is designed to achieve, whether it's for a current income, for a certain level of beta, for participation in different themes.
Do you see that being a permanent shift, or do you think it's something that maybe fades a little bit over time as well?
I think it's an expression of the market here in the region becoming more mature and having more access to different types of return streams. It's no longer just a market for passive investing. It's no longer just a market for finding single ideas to express a view. It's a market where you have a lot of options and access to different vehicles and return streams, and that is a sign of a maturing market and a market that is exciting for our clients to traffic in.
Thinking also a bigger picture, the world, it's not just sort of Trump 2.0. This is sort of a geopolitical change that is much larger. So how are you preparing as well for that, and what exactly are you expecting or seeing?
Certainly one of the themes that has become pervasive through our client conversations is about the world becoming more multipolar. Right? We are servicing our ultra high net worth clients who have moved from a world that was a world of globalization and into a world where nations are prioritizing national security over open trade, where there's a lot of investment in reshoring and domestic industries and fostering that innovation within your own industry, which is a fantastic thing. But that does mean that there will be a different dynamic for the way that we think about global industries and global supply chains.
And then does that also change maybe the sectors that you look at there as well, the themes that you're considering?
Well, certainly one of the themes that is still very pervasive is the technology developments and the developments in AI. We talked earlier about US exceptionalism, and that's been dominated by a lot of the Mag 7 stocks. But the reality is we're just in the early innings of AI development. The last few years, since the pandemic, we've seen a lot of focus and investment in AI infrastructure. It's now time for us to move from that digital realm into the physical. By the digital, I mean large language models, I mean APIs, and we're really starting to move into the world of how do we translate that into physical. How do we translate that to humanoids and robots? That's going to transform the way that we live, work, interact with each other. That's going to challenge the way that productivity is measured and economic activity works in this world.
Sometimes these changes feel like they're happening really fast, but sometimes also it's something that happens over, humanoids, for instance. We're talking about something, by some estimates, maybe $7 trillion, but by 2050. So it's several decades away. How do you also approach investors and talk to them about generational wealth transfer and that sort of succession planning as well?
Well, it's absolutely important within wealth. We're talking about wealth management here, right? So wealth management is about long-term structural trends. It's about what are you passing on within your family, within your company in terms of legacy? What are you wanting to be investing in for the future? So those conversations are quite natural with our clients. Now it's about thinking, how do we implement that? If anything, some of the more interesting conversations that we're having is how does the next generation convince the previous generation that this is the theme that we want to be investing our resources and our time in. And that's why we invest a lot of our efforts and resources into educating not only the next generation of wealth, but the next generation of wealth together as a whole in terms of nurturing that legacy.
Okay, we've got a couple of minutes left, and I think you know where I'm about to take this conversation, but I believe we have a photo that we can show of something that Christina gets up to in her personal life as well. And I mean, I know you know the photo, so maybe just talk us through what's happening here.
Well, I think this is probably a photo of me in a car. It's drifting, and drift. I don't race, actually, to be completely clear. I like to drift cars, which is the act of using the throttle to spin out the back of the car in such a way that you can move the car sideways. I think it's a very fun way of controlling a machine. I mean, actually, just like fund management, right? Just like markets that can be unpredictable and powerful and volatile, and in the hands of someone who's not skilled at navigating that, it can go everywhere. But if you have the skills and the technique to navigate a machine, to use something that has so much power and move it in a way that is precise, that I think is a fascinating skill to have and great fun.
So just to wrap it up then, I guess, those skills, I mean, I know you sort of nodded to it, but what you're learning in drifting, does it feed very naturally into your work life as well?
I think it does. Look, it should go without saying that having a rich personal life, and that includes your passions and your health, are mutually accretive with being productive at work and being an interesting and fulfilled person at work. And I certainly encourage everyone to be nurturing their personal passions as well as their professional, as it relates to using a machine and being able to be precise with it. Actually, one of the things I'm trying to finesse right now is that you don't have to use a steering wheel to move the car in exactly the direction that you want it to. You just use the throttle. And the better you are at feeling that throttle, the better you are at navigating that machine. And I think that's something that we can all apply in our work and what we do.